Oil has increased by 40% since February, and the reason for this is not being widely explained. The rapid increases in gasoline costs are unpleasant in themselves, but this larger increase is part of a much more significant development. This is a subtle exercise of power that could reduce your retirement funds more rapidly than any economic downturn. You will learn how a subdued oil conflict between countries you are unlikely to know may determine the amount of your future retirement payment. This is not simply about crude oil, it's about dominance, the dollar being at risk, and the way the wealthiest countries are altering the power structure as you are preoccupied with small shifts in the stock market. If you believe that $5 per gallon gasoline is the worst aspect of this situation, you are far from correct. Oil prices do not increase randomly. Each price increase is a story of ambition, planning, and authority. This most recent increase of 40% since February did not happen without reason. It began quietly, with a few decreases in production, some international disagreement, and many private agreements. Now it is escalating. The majority of investors still consider oil prices to be simply another point on a graph. However, a sequence of events which affects your spending, grocery bills, and even your retirement savings lies behind that line. When the price of oil goes up, everything else is affected, including food, transport, production, and even your Friday night pizza. Energy is the basis for all activity. Let's return to the beginning. In early February, a barrel of oil cost approximately $70. By mid-March, the cost was almost $98. This is almost a 40% increase in only a few weeks. Those analyzing the situation have called it speculation, but it is more than that. This is not just a question of the markets, it is about influence. Whoever controls energy controls the situation. Washington, Riyadh, and Beijing are currently controlling the situation. The United States, Saudi Arabia, and China are three groups involved in an energy relationship that is quietly changing the global financial system. For the last 50 years, the world has purchased oil using US dollars, strengthening something called the petrodollar system. Every country requiring oil had to possess dollars. This maintained a high global demand and allowed America to borrow inexpensively and exert its influence. The dollar was not only currency, it was power. However, this is changing. Saudi Arabia has been, in private, considering arrangements with China to set the price of oil in yuan. This is not only an economic change, but a representative one. If oil can be bought and sold without using dollars, the world will require fewer. When the worldwide need for dollars decreases, the value of your savings, your investments, and even your D401k will gradually fall. A weaker dollar will make imports more expensive, cause inflation to increase, and drive up the price of everyday items. The Federal Reserve can attempt to combat this by increasing interest rates, but this could hinder economic growth and decrease stock values. In either case, your investments will be impacted. Most people don't realize that oil is far more than just another product to be bought and sold. It is fundamentally important to the stability of the entire global financial system. When oil prices go up substantially, inflation doesn't simply return, it increases rapidly throughout the economy. Businesses will find their operating costs are higher, consumers will curtail their spending, company earnings will decrease, stock market indices will fall, and individuals will experience a gradual reduction in the value of their retirement funds. Currently, the Strategic Petroleum Reserve, the United States emergency oil supply for times of high prices, holds the smallest amount of oil since 1980. It was depleted last year in an attempt to lower prices. However, rebuilding the reserve now would require many billions of dollars. The government's most effective measure was used when oil was cheaper, and it is questionable whether it will be effective in the future. At the same time, the balance of power concerning oil is shifting. Russia, subject to penalties from Western countries, is selling oil at reduced prices to both China and India. India, in turn, refines this oil and then sells it on the world market for a higher price. Saudi Arabia is in the process of changing its agreements, and the United States, formerly the leading energy producer, is observing the creation of new alliances from which it is excluded. The international energy market once operated under a single principle, that all transactions would be completed in US dollars. Now, there are multiple ways to keep score. When each country begins to use its own currency for energy trades, the global market breaks into pieces, volatility increases, obtaining credit becomes more difficult, and longer-term investments become unstable. Consider this analogy. Global commerce has been like a game of musical chairs. Every transaction, every barrel of oil, every agreement was calculated in dollars. But the tune is changing and the chairs are being moved. When the music stops, someone is going to be left without a place to sit, and this time that could be the US dollar. Should that occur, investors from other nations will gradually decrease their purchases of US government bonds. This will result in increased interest rates, more expensive loans, higher credit card debt, slower economic expansion, and a decline in stock market performance. This is a combination of factors which can steadily erode your long-term savings. Though it sounds extreme, this process is underway. Review your mutual funds or exchange-traded funds. The S&P Force 500, which performed very well for 10 years, is now more vulnerable than it appears. As energy prices rise, corporate profits fall, and when profits decrease, the markets reconsider their assessments. Most investors are not harmed by a sudden collapse, but by the slow, unobserved decline over several months. Wall Street professionals like to describe this sort of fluctuation as a healthy correction. But that is comparable to describing a house fire as a natural adjustment to heat. I'm interested in your opinion. Do you believe this increase in oil prices is only a temporary occurrence or the beginning of a more substantial trend? Please share your thoughts in the comments section. I will read all replies and am keen to know whether you see this as a danger or as a potential benefit. If you find this explanation useful, please subscribe, because over the coming months, the performance of your investments will likely be determined by developments in energy markets to a far greater extent than by company profits. The reality is that the United States oil security margin is diminishing at a time when other nations are increasing their own. China, for over a year, has been quietly accumulating a large oil reserve, making deals and preparing for a period of price instability. Simultaneously, American oil processing facilities are old, the search for new oil has decreased, and our country isn't producing enough oil to satisfy current demand. Consequently, the United States is more immediately and severely affected when oil costs increase. Drivers will pay more for fuel, shipping expenses will go up, food costs will increase, and inflation will begin to rise. Investors will then be faced with a difficult question. How can you protect your investment from a worldwide conflict over oil? Some will choose to invest in funds that track energy or specific commodities, and others will look to international diversification. Regardless of the chosen strategy, the basic situation remains the same. The world is moving away from the stability that has been provided by a single currency, and this will likely mean more unpredictability in the years to come. We are currently witnessing a gradual, almost unnoticeable shift in global power. This change is not occurring through public events or pronouncements, but through agreements and the exchange of currency. It isn't being reported as breaking news, but is being shown in the subtle alterations being made to investment portfolios across the world. If the price of oil increases by another 20% this year, which is entirely possible, it will not only impact the price at the gas station. The increase will have a broad effect on housing, travel, the technology sector, and all aspects of worldwide supply chains. As a result, inflation will rise again. Central banks will react with concern again, and the markets will become unstable again. This problematic cycle will continue without much attention, and most people will attribute the issue to general feelings about the market. The difficult fact is that conflicts over oil do not resemble traditional wars. They are marked by steadily increasing prices and a decrease in the value of money. They appear as slow pressures on international shipping lanes and as charts that decline by just enough to make long-term financial planning uncertain. What will happen if the world ceases to use dollars for oil transactions? What if the petrodollar system fails completely? The United States would lose a significant benefit: the ability to create and borrow money with relatively little impact. Without that advantage, debt would become a heavier burden, the markets would be less stable, and the value of your savings would decrease each year. Therefore, this is not simply a matter of oil, it is about everything that oil influences. It is not an energy story, but a story of global leadership. Each barrel of oil traded in a currency other than the dollar is a small weakening of the financial dominance of the United States. Over the coming months, the performance of the energy markets will likely have a much greater impact on your investments than the reports from companies on their earnings. To return to this matter, the United States' protection against oil supply shortages is diminishing precisely as other nations are increasing their reserves. China, for over a year, has been steadily accumulating oil, making arrangements for purchases and preparing for unstable conditions. At the same time, American oil refineries are getting older, the search for new oil has decreased, and our own oil production is not meeting the current level of demand. Therefore, when oil prices increase, the United States experiences the effect more quickly and severely. Consumers will find higher prices at the gas station, the cost of shipping will increase, food costs will slightly rise, inflation will begin to grow once more, and investors will begin to ask a question nobody wants to be faced with: how can one protect investments against a global conflict over oil? Some are choosing to invest in funds that track the energy sector or in commodities, and others are choosing to broaden their investments to include international markets. However, the basic issue remains: the world is moving away from the stability that comes from relying on a single currency, and this will lead to more fluctuations in the market for the foreseeable future. We are currently witnessing a gradual, almost unnoticeable change in global power. This is not happening due to meetings or official statements, but with business agreements and currency exchange. It is not being reported as breaking news, but instead is reflected in the subtle changes to investment portfolios around the world. If oil were to increase in price by another 20% this year, a possibility that should not be discounted, the effect would extend beyond the gas pump. The impacts would be felt in the housing market, the travel industry, the technology sector, and anything related to the movement of goods around the world. Subsequently, inflation would jump again, central banks would react with concern, and the markets would become unstable once more. This negative pattern would repeat without much noise, and most people would attribute the issues to general market mood. The difficult fact is that oil conflicts do not manifest as traditional wars. They show up as steadily increasing prices and a decrease in the value of your money. They present as a gradual strain on international shipping routes. They appear as slight declines in charts that are enough to make planning for retirement uncertain. What if the world stopped using dollars to purchase oil? What if the petrodollar system, the use of US dollars in the oil market, collapses? The United States would lose a significant benefit: the ability to create money and borrow funds with very little in the way of negative consequences. Without this, the national debt would become a heavier burden, the markets would be more unstable, and the buying power of your money would decrease each year. This is why this is about much more than oil. It is about everything that oil impacts. This is not just an energy issue, it is a story about global power. Each barrel of oil bought with a currency other than the dollar is a small reduction in the foundations of the United States' financial strength. Oil has historically been essential to how the world as we know it functions. However, it is now the focal point of a struggle. This isn't a conflict involving military forces, but one of financial instruments, agreements, and careful planning. The 40% increase in price you are observing is not simply a consequence of events. It indicates a redirection of global capital towards locations with a reliable energy supply. This price increase might diminish over the next few months, or it may not. Regardless, to disregard this situation will have consequences. This oil-based economic competition is in fact influencing your investments, your accumulated funds, and the price of items you purchase daily. Therefore, instead of asking about the current price of oil, the more important consideration is the expense of acting as if this situation is unimportant.